Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the 9th best-selling tracker fund on the AJ Bell UInvest platform at the moment, namely iShares UK Property ETF. This tracker product is an ETF or exchange traded fund. It's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. In this case, the tracker is following the FTSE EPRA Nareit index as closely as it possibly can. Now I know that's a bit of a mouthful, but the underlying benchmark comprises quoted real estate companies and real estate investment trusts or REITs, and they're listed on the London Stock Exchange. Although they're UK based and UK quoted, they may have some overseas operations, even if the bulk of their operations are based right here in the UK. The tracker follows the share prices of just 19 firms, so the portfolio is a pretty concentrated one. You know exactly what you're getting here. Key holdings include FTSE 100 members, Land Securities, British Land, Intu and Hammerson. iShares UK Property uses physical or direct replication to generate performance, so it owns the underlying securities but not the real estate or the buildings themselves. Launched in 2007, the tracker's got about 685 million quid in assets under administration, and it comes with an ongoing charge figure of just 0.4% a year. The yield's around 2.5%. Dividends are paid quarterly. As a final point, iShares UK Property is one of the 16 members of the top tracker list used by our investment guidance service, although I should say it doesn't actually feature in any of the 3 model portfolios at the moment. So that's the mechanics. The question is, why would your fellow investors be buying iShares UK Property now? Well, I think there are 3 possible reasons. First, property is probably best seen as a long-term investment and one which can provide both income and capital gains when all goes well. The tracker invests in quoted property developers and managers, so it should in theory be more easily traded or liquid than the actual buildings themselves, at least under normal stock market conditions. Second, the dividend yield of 2.5% may appeal to income hunters, as it beats the rates available on most cash accounts and also the yield on the 10-year government bond or gilt, which is barely 1.2% as I sit here today. And third, the big quoted real estate investment trusts or REITs, well, they've been very volatile in the run-up to the EU referendum vote as the markets become nervous over whether any Brexit would hit appetite for UK assets, including property. If the UK votes to remain, the underlying stocks may rally, taking the iShares UK Property tracker along with them. Equally, clearly therefore, the risk is the UK votes to leave and the REITs come under pressure again. Although as a final point, here's the performance of the tracker over the past year. As you can see, it bottomed on the 24th of February, just a few days after Prime Minister David Cameron called the referendum. So deep down, despite the volatility, maybe investors think the result of the ballot will be Remain. Once the vote's out of the way, then other fundamental considerations will come back into play, such as supply and demand of major office buildings and the state of the UK economy. And since property is best used as a long-term asset, you will need to do your research here and form your own views on what may happen with the vote and what may already be factored into the valuations of the tracker's underlying holdings before you assess whether iShares UK Property is suitable for your own portfolio or not. So thank you for watching, and I look forward to seeing you next time.